Welcome back to Investing Talk Podcast.
Today we're looking at Broadcom.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We're looking at a company that is, it's undeniably a powerhouse, just tremendous fundamental strength. But it's also sitting right at this strange intersection of, traditional enterprise infrastructure and an AI market that is just, it's changing so fast.
Okay, so let's start with the bull case, because the financial foundation here is, well, it's about as solid as it gets. They are executing at a massive scale.
Oh, absolutely. They just reported net revenue for Q2 2025 of, $12.7 billion.
And to put that in perspective, that's up from $11.5 billion just the year before. That kind of growth at this size is just exceptional.
It really is. But the revenue number is only half of it. What really tells the story, I think, are the margins. Gross margins were reported at over 75% for Q2.
75%.
Yeah. Think about that. For every $4 that come in the door, 3 are gross profit. And their net income margin is stable, above 40%.
So this is a business model that is just dialed in for efficiency.
Completely. It's built around high-value IP and incredibly efficient manufacturing.
And when we look out for the full year, the market seems to be betting this continues, right? Especially with AI and that huge acquisition they made.
Exactly. The analyst consensus is projecting that their full-year fiscal 2025 revenue will actually break $50 billion.
$50 billion, wow.
And that huge jump, it's really resting on two main pillars. First, just the continued explosion in AI, right? Data center connectivity, custom silicon. And second, and this is the big one, the integration of VMware.
Right. A massive deal. It brought a lot of debt, but it's designed to completely change their position in enterprise software.
Which is where that balance sheet becomes so important.
Mm-hmm.
They're holding over $10 billion in cash. So even with the VMware debt, their net debt to EBITDA ratio is below 2.4.
Which is very healthy, especially after a huge deal like that. It gives them a ton of flexibility.
A ton. And they're using it. Their free cash flow was robust, to say the least. Yeah. $4.5 billion in the quarter.
And that cash is going right back into the business. R&D, some buybacks.
And a pretty substantial dividend. It was $4.60 per share paid out in June. So they're investing in growth and rewarding shareholders at the same time.
Okay, so beyond the pure financials, what's their competitive advantage? What's the moat, especially now that they've swallowed VMware?
Well, the moat is getting deeper, I think.
Mm.
On the chip side, they are still the leader in data center interconnect and broadband. They're sort of the essential plumbers of the internet.
Right.
But the VMware integration, that's the real strategic play. It lets them move from just selling hardware to selling these bundled software and hardware solutions.
Which makes them incredibly sticky for big enterprise customers.
Incredibly. If you're a huge company trying to manage a complex cloud setup, having one vendor for the whole stack is a very, very compelling offer.
Okay, that's a powerful long-term story. What about the near term? What is the stock chart telling us right now?
Well, over the last 3 months, the shares have been in a pretty steady bullish trend. We saw them move up about 11% from around $305 in late August to about $340 now in November.
And technically speaking, that momentum looks solid.
It does. The stock is trading consistently above both its 50-day and 200-day moving averages. So from a technical standpoint, that reinforces the bullish view.
Yeah.
We're watching support levels around 315 and 325.
All right, let's switch gears to something that I think confuses a lot of investors. Insider activity. We've seen reports of some big share sales from executives, even the CEO. How should we interpret that when the financials look this good?
That's a great question, because on the surface, it can look alarming. But you have to dig into the context. A lot of these sales, they were prearranged. They're done under what are called Rule 10b5-1 plans.
And for anyone who doesn't know, that's basically a preset schedule for selling stock, right?
Exactly. An executive sets it up months, sometimes a year in advance. It means the sales happen automatically on a certain date, no matter what secret, non-public information they might have at that moment. It's a defense against insider trading accusations.
So it's more about personal financial planning than a lack of confidence in the company.
Precisely. And what's interesting is that if you contrast that with other recent filings, you actually see other C-level officers exercising options and increasing their holdings.
Okay, so that paints a much more confident internal picture.
It does.
But confidence is one thing. The market needs catalysts. What are the big events we should be watching for in the next few months?
The big one, the most pivotal event, is the Q4 earnings announcement. That's scheduled for December 12th.
And the market will be watching that one like a hawk.
Absolutely. Everyone will be listening for the forward guidance. How fast is AI demand ramping up? Or they hitting their synergy targets with VMware? That's the call where we find out if that $50 billion revenue forecast is real.
Any other dates or even just market chatter we should know about?
Well, right at the end of the year, on December 30th, you have the big ETF rebalancing for the S&P and Nasdaq. That can cause some weird short-term volume spikes.
And what about rumors? There are always rumors.
Yeah, there are. Two big ones right now. First, there's a lot of speculation about them landing a huge new custom silicon deal with a major AI cloud customer.
That would be a massive win.
It would be. And it could really boost 2026 revenue. The second rumor is that, given all that free cash flow, people are expecting a big dividend increase to be announced with the December earnings.
Okay, so that is a really formidable bull case. Rock-solid financials, a deepening moat, and some near-term catalysts. But this is where we have to flip the coin, isn't it? Because there's this fundamental threat emerging from the very market that's fueling all this growth.
That's the tension. That is the core of this whole analysis. For years, NVIDIA has just dominated the AI space. Over 80% market share.
The only game in town, basically.
Right. But that's changing. The whole market is shifting away from general-purpose chips toward highly specialized hardware.
And the biggest challenge on that front is coming directly from one of Broadcom's biggest customers. It's coming from Google.
From Google. Specifically, their 7th-generation custom chip, the Tensor Processing Unit, or TPU. The code name is Ironwood. And this is not just some internal science project anymore.
No, this is a full-blown commercial push.
Exactly. I mean, the performance claims are just jaw-dropping. A 4x performance boost over the last generation and a 10x peak improvement over their V5P chip.
But the real signal, the really worrying thing for the rest of the market, is who's signing up to use them.
Right. It's Anthropic, the company behind the Claude AI model.
And what are they doing?
They've committed to using up to 1 million Ironwood TPUs.
1 million. That's an industry-defining number.
It's a huge signal that the biggest AI players are moving away from relying only on general-purpose chips. They want performance, and they want better pricing.
And Google is pouring money into this custom silicon war. Their CapEx forecast is now, what, $93 billion?
An unbelievable amount of money. And a lot of that is going right into building out this specialized infrastructure, which, directly competes with the kind of custom solutions that Broadcom sells to these very same companies.
So to really understand why this is happening, we have to look at the AI models themselves, right?
Yeah.
It's not just about the chips.
It's all about the models. Specifically an architecture called Mixture of Experts, or MOE.
Okay, let's unpack that. MOE. What does it actually mean?
So MOE models, like Google's Gemini 3 Pro, they change the whole scaling game. Before, to make a model smarter, you had to make the whole thing bigger, which made it way more expensive to run.
Right.
MOE works differently. It lets you scale a model to trillions of parameters, but the cost to process a single query stays flat.
How does it do that?
Through something called sparse activation. So instead of the whole giant model lighting up to answer your question, only a few small expert parts of the model get activated.
Like going to a library and only pulling the 3 books you need, not checking out the entire library.
That is the perfect analogy. It's incredibly efficient.
But you're saying that efficiency creates a huge hardware problem.
A massive one.
Yeah.
A huge one. Because you have all this unpredictable, bursty communication happening between thousands of chips as data gets routed to the right expert. The network fabric, not the computer chip, suddenly becomes the bottleneck.
And this is where Broadcom's traditional strength in high-speed networking gear starts to face a real challenge.
Yes, because Google's Ironwood TPU solves this problem with a completely different proprietary approach to networking.
Yeah.
It uses 2 key things: a high-speed inter-chip interconnect, the ICI, and this is the critical part, an optical circuit switching fabric, OCS.
Optical circuit switching, that sounds very different from standard networking.
It's a game changer. Standard networking, which Broadcom excels at, breaks data into packets. OCS doesn't do that. It uses light to create direct, physical, dedicated pathways between chips instantly.
So it's like building a temporary private highway made of light for the data to travel on.
Exactly. And for MOE, that's everything. It gives you the super low latency communication you need for that expert routing to happen without a bottleneck. And that proprietary networking solution is a direct threat to the custom networking chips Broadcom designs.
Okay, so they solved the network problem with OCS, but what about the chip itself? You said sparse data is messy. How does the chip handle that?
Right, so that's where the specialization comes in. The Ironwood TPU has a dedicated accelerator on it called the sparse core. You see, sparse data creates these irregular data shapes called ragged tensors. And traditional compute units, the MXUs, are just really bad at handling them.
So the sparse core is like a special tool built just for that messy, irregular data.
Precisely. It handles all the weird, irregular stuff, which keeps the main compute engine from getting bogged down. It's co-designing the hardware for the specific problems these new models create.
And the software is the glue that holds it all together.
It's the third leg of the stool. It's essential. They use the JAX and XLA compiler stack, which optimizes everything. It fuses lots of small operations into one big one, which minimizes memory access and just makes sure that specialized silicon is being used to its absolute maximum potential.
Okay, let's synthesize this. Broadcom is a financial titan, unbelievable market leadership in its current world of enterprise and general purpose interconnects. That's the bull case.
Correct. In their financials, their cash flow, their market position, it all makes them incredibly resilient. And they are perfectly positioned to profit from the general growth in AI and data centers.
The structural threat is that their biggest customers are now proving they can just build their own vertically integrated solution and bypass the general purpose market that Broadcom serves.
That is the critical perspective you have to have.
Yeah.
While Broadcom is absolutely cashing in on the AI boom, the success of these proprietary integrated stacks, like what Google is building, it poses a real evolving structural challenge.
It means Broadcom has to execute flawlessly on its own custom silicon partnerships. They can't afford to fall behind.
If this proprietary model becomes the standard, that wide moat that Broadcom has around networking could start to look a lot smaller, a lot faster than people think. Next quarter will be fascinating. It's not just about Broadcom's numbers, but about observing how quickly the shift from general-purpose GPUs to highly specialized AI infrastructure fundamentally redefined where the real leverage lies in the tech sector.
That is a phenomenal forward-looking point. If you want to stay on top of how this fundamental shift impacts your investment decisions, make sure you keep tuning into our analyses. You don't want to miss what we cover next.